Birla Soft Limited Q1 FY2026 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Abhinandan Singh, Head Investor Relations, Birla Soft. Thank you, and over to you, sir.
Thanks, and welcome everyone to our Q1 FY26 earnings call. You already have received our results or seen it on our website. Before we get started, let me quickly introduce you the members of our team who are present on this call along with me here. We have our CEO, Mr. Angan Guha, with us. Along with him, we also have our CFO, Ms. Kamini Shah, and along with her, we also have our CFO designate, Mr. Chandrasekhar Tyagarajan, or Chandru as we call him. We will begin the call today with opening remarks from both Angan and Kamini as usual, and after that we will open the floor up for your questions and responses to those. Before I hand over the floor to Angan, a quick reminder that anything that we say on this call on the company's outlook for the future could be a forward-looking statement involving significant uncertainty, and therefore that must be heard or read in conjunction with the disclaimer that appears in our investor update, which you would have received and is also uploaded on our website as well as filed with the stock exchanges. With that, let me hand over the floor now to Mr. Angan Guha, our CEO and MD. Over to you, Angan.
Thank you, Abhi. So good evening and good morning to everyone wherever you are, and thank you for joining us today as we share some perspectives of our performance during the first quarter of the financial year FY26. As you already know from our announcement a couple of weeks ago, Kamini, who has been serving as our company's CFO since April 2023, has decided to move on for personal reasons. I would like to take this opportunity to thank her for her contribution over the past 2 odd years in driving the efficiencies and ensuring strong cash flow generation. So thank you, Kamini. I'm also pleased to welcome Chandru, who will take over as our CFO effective tomorrow, which is the 8th of August, back to Birla Soft. As many of you may recall, he served as the company's CFO earlier during the period of 2020 to 2023. Chandru is a highly accomplished and seasoned finance leader and is also very familiar with our business. We are therefore pleased that we were able to find in him the best possible person to step in and take on the role of the company's next CFO. So now with that backdrop, let me delve into our Q1 performance. You may recall in our last earnings call, I had mentioned that we were witnessing some ramp downs as well as some insourcing amongst few of our customers, which was likely to affect our growth performance in Q1. That was mainly on account of the prevailing macroeconomic environment where customers are still focused on cost optimization, cutting back on discretionary spending, and are maintaining a hold and wait approach with regard to large transformational programs. Consequently, the revenue for Q1 has been sequentially lower by 1% in dollar terms and has come in at $150.7 million. However, 3 out of our 4 verticals have actually shown growth. BFSI, Life Sciences and Services, and Energy Utilities have delivered sequential growth in dollar terms during the quarter. However, our manufacturing vertical, which is our largest vertical, has registered a very soft performance due to project completion, ramp downs, as well as insourcing, which has more than offsetted our growth that has been contributed by the other verticals. On the margin front, we entered Q1 with a base effect headwind because in Q4 we had significant amount of margin tailwind due to some one-offs that were absent in Q1. In that backdrop, I believe we have managed to minimize the margin contraction sequentially and delivered an EBITDA margin of 12.4% for the quarter. Kamini will share more on margins and net earnings in her remarks. Coming to deal wins, more than half of the TCV secured in Q1 comprises of new deals that we have won during the quarter. The quantum of TCV deal wins in Q1 is at about roughly 141 million. However, this is lower than what we had delivered in Q4 because, as you know, the second half of the financial year, which is the third and the fourth quarter, are very renewals heavy. So traditionally, the Q3 and Q4 deal wins are higher. In addition to that, there was one deal that got right shifted to Q2, which is why you saw a little bit of softness in signing deals in Q1, but we are hoping that we will cover it up in this quarter, which is the quarter end concern in Q2. But I would also like to point out that we have secured some marquee deal wins that demonstrate our enhanced tech capabilities, particularly in emerging areas such as Gen AI. For instance, we have partnered with a leading player in the U.S. energy sector to deliver cutting-edge agentic AI use cases within the supply chain, accelerating intelligent automation and operational resilience. Similarly, we won another engagement with a global technology leader for a landmark enterprise-wide quality engineering transformation program wherein we will be integrating agentic AI-driven automation. These engagements will add to our growing base of existing customers where we are already deploying advanced AI-powered capabilities, including agentic AI. Now, looking ahead, as I've observed earlier in my comments, the demand environment continues to be difficult. This has resulted not only in prolonged period of time during which customers have been reluctant to take up long-term transformational projects, but also in delayed decision-making and cut in their discretionary spending. As a result, while our pipeline remains strong, conversion to deals have been relatively tepid. While we expect sequential growth in Q2, we do anticipate that the challenging market conditions will reflect in our performance through the course of the current year. At this point, I will ask Kamini, our Chief Financial Officer, to share her perspectives on the quarter under review. Kamini, over to you.
Thank you, Angan. Good day, everyone. Thank you for joining us. It's a pleasure to talk to you again. Let me take you through some of the financial highlights for the first quarter of FY26. Our revenue performance for Q1 reflects the challenging demand conditions that we are operating under. On our last call, we had indicated that we are seeing some project closures and ramp down, and on account of that, our revenue for the quarter declined 1% quarter on quarter in dollar terms to $150.7 million. As Angan has observed in his remarks, 3 out of our 4 verticals have registered sequential growth during Q1 in dollar terms. Energy and utilities sustained its growth trajectory during the quarter under review, growing 1.9% quarter on quarter. BFSI has also grown, albeit marginally, and life sciences and services verticals have returned to growth during Q1, recording a 1.4% growth quarter on quarter. The manufacturing vertical, however, witnessed a 4% quarter on quarter degrowth, which is for the reasons that Angan had mentioned. If you really look at our service line, our ERP business saw a sequential decline, reflecting its correlation with the manufacturing vertical. The infra business, which is a much smaller piece of our overall business, also witnessed a degrowth due to completion of a project. The digital and data business, however, has registered a growth of 2.6% quarter on quarter. This is on the back of new engagements and incremental revenue from existing accounts. You would recollect that in the last call, we had mentioned that our Q4 25 margin performance had some one-time benefits pertaining to currency benefits leave encashments, and variable pay for our senior executives amounting to about 200 bits. We had also indicated that we were confident of offsetting half of the margin headwind coming into Q1 through operational efficiencies. We have been able to minimize sequential margin contraction in Q1 despite a subdued top line and delivered an EBITDA margin of 12.4% in Q1. The effective tax rate, which for us has historically been in the 25 to 26% range, saw a rise during Q1 to 35.9% on account of a provision made for higher tax. We have been engaging with tax experts and are transitioning our terms of engagement with key customers to more accurately align with our operating model. With this, we expect to limit the impact of the incremental tax to the current financial year. Thereafter, we expect the ETR to come back to our historical levels. Adjusted for the incremental provision for tax, PAT for the quarter would have been at 14.4 million and basic EPS at 4.39 per share. We have begun the new financial year with a robust balance sheet. Our cash and cash equivalents at the end of Q1 stood at 266.6 million. This is up by about 16% year on year and 2.8% quarter on quarter. Our DSO was at 58 days, while it is higher than what we normally reported in the earlier quarter. This has been primarily due to delayed collections that have come in earlier July. Had these collections come within the time frame of June, our Q1 DSO would have been at 53 days. We remain committed to staying focused on sustained robust cash flow generation. While we are still navigating through the challenging demand environment, I believe our ongoing efforts to drive operational efficiencies, generate healthy cash flows, and invest prudently in the business positions us well to benefit from a recovery in demand as and when that happens. Thank you very much. Back to you, Abhi.
Thank you, Kamini. Thank you, Anand. Moderator, can you please open the floor for questions?
Sure, sir. Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question, you may press star and one on your touch-tone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. We have our first question from the line of Girish Pai from BOB Capital Markets. Please go ahead.
Thanks for the opportunity. Angan, you mentioned that 2Q is going to be a growth quarter on a QOQ basis. Will that continue into 3Q and 4Q?
So Girish, thank you for your interest and thank you for asking me that question. So look, we are working towards a sequential growth in Q2, and our focus currently is Q2, and we are working with our teams and with our clients to see how we can deliver sequential growth in Q2. Now, it'll all depend upon how my order book stacks up for Q2. As I'm sure you've seen, and I mentioned in the call, our Q1 we delivered about $141 million worth of orders. One order slipped into Q2, which is now getting signed. So hopefully Q2 we'll have a larger order book, right? Now, if we really deliver a larger order book, then barring the furloughs, I think operationally we can show some growth, but that will all depend upon how the Q2 order book looks like. It's hard for me to say whether Q3 will really be a growth today because of the uncertainty that we are facing. But our job is going to be to focus on order book and deliver higher order book, which will make sure that the revenue growth comes in subsequent quarters.
Okay, and in the previous calls, you've been saying that you would want to lower the exposure to discretionary business from what I think was 70% to about a 50-50 mix. Where are we on the journey, and is the new business coming at lower margins compared to the discretionary business that you've been getting?
Yeah. So Girish, so here is how I'm seeing it play out, right? And as you know, our quarter one and quarter two are quarters which generally is a little lower in terms of order book, because that's how our seasonality works, right? Q3 and Q4, the renewals are very heavy. We are not anticipating at this point in time, and again I stress at this point in time, that our renewals will be at a lower margin. Our renewals will be at our current margin at the minimum, and in certain cases we may get a little bit of a extra margin even in our renewals business. However, what will happen though is in our new deals, and I also talked about 2 or 3 big deals that we are working on in the range of about 30 to 50 million, those deals will definitely come at a lower margin. So for us as a management team, it will be important to first of all win those deals, secure those deals and deliver, and also work on our overall cost theme so that we can sustain the margins at the current levels, Girish.
Just 2 more questions on salary hikes. When will they happen, and the quantum and the impact from a basis points perspective? Which particular quarter will it hit you?
So we have not taken a decision on salary hikes just yet. I mean, we've just started the first year. I mean, as you would recollect, even last year we gave the salary hike only in Q3 of our financial year. So it's just been about a quarter. So we've not taken a decision on that yet, Girish.
Yeah. And just to add to that, Girish, our senior leadership salary hikes were done at the beginning of this year, around January, that is quarter 4 of last year. So at this point of time, we will review the situation and take a decision on whether we would do it.
Lastly, I had a question on the industry, and there's a lot of talk about H-1B visa process change that may happen from a lottery to something else. Should it change from a lottery process? From an industry standpoint, would that be an additional margin pressure that the industry is going to see?
Yeah, so Girish, we'll have to wait and watch in terms of how it shapes up, right? Currently, we don't have a comment on that because we'll have to see the new regulation, the way it comes out, and only then we can assess the situation. But currently for us, the way our business is shaping up, we have enough H-1B resources ready to travel if needed, and we are also localizing our workforce by hiring locally. So I think we are covered at this stage unless the visa situation changes dramatically, which we can't comment on at this stage, Girish.
Okay, thank you.
Thank you. We have our next question from the line of Priyank Chheda from Valum Capital. Please go ahead.
Yeah, hi team. Hi Angadji. Thank you for the opportunity. I'm sure in these challenging times, there are a lot of things that, outside the macro, something that Birla as a team and the management team would implement so that we emerge out much more stronger. So I would want you to highlight the key learnings that you have had in this last 12 months or 4 quarters, which have been more challenging, and any corrective action plans that you have undertaken from those learnings.
So Priyank, again, thank you for the question and thank you for your interest in our company. So look, one of the biggest learnings for me and my management team in the last 1 year has been the fact that our order book has not been very strong, as you all know, right? So there is an enormous focus on our building the pipeline and driving more order book. I think if you remember in FY24, we delivered about $850 million worth of orders, which came down to almost 750 last year, right? So one of the big learnings is unless we have an order book, obviously the revenue growth becomes a challenge. So one, the entire team is focused on driving order book. So that is one. Second is we also realize that we need to be more domain orientated, and as a result, our new hiring that we are doing is building on more domain oriented hiring rather than generalist hiring. So that's number 2. Number 3, and we talked in our commentary, how do we drive a lot of delivery through our agentic AI platforms, and we have some marquee platforms which are really truly amazing platforms, if you will. How do we use those platforms to deliver to our customers and win new deals? And we are focusing on that as well. We've also undertaken a company-wide transformation on all parameters, whether it is customers, how do we serve customers better, what are the capabilities we build, and finally on the cost side. And in a situation where there is so much uncertainty, we will obviously work a lot more on the cost. And again, I want to make it very clear, it's not that we will fire our employees or anything. That's not the idea. But the right roles need to be done in the right geographies, which is what we will focus on, number one. And number two, we will continue to invest in the areas that we see growth, right? So as you have seen, our digital and data business has shown a lot of growth. We want to continue to invest in that kind of business, but we need to kind of move the workforce in the right geographies where they actually need to be. So while we are looking at the cost side significantly, but keeping the long term in mind, we also want to invest in the right places. So I guess broadly, Priyank, these are the big learnings, but if you ask me, our biggest job right now is to get the order book fixed. And if we can get the order book fixed, then the revenues will follow.
Very clear. And should we see this implementation getting populated into order book like you mentioned, from the first large deal that we are already working on it, which got slipped. So from Q2 onwards, the clear mandate would be to first check the order book and its accretion, and then would show the delivery follow.
That is exactly right, Priyank. I mean, I'm hoping that we deliver more order book in Q2 than what we did in Q1 for sure. And then Q3, Q4, obviously the renewals come in. And then if we can swing at least one out of the two large deals, then clearly, the year will be good in order book. And I'm hoping if we can deliver strong order book for the year, then next year, we can commit to a larger growth.
Perfect. So just to summarize this year, the more focus would be on order book than the revenue recognition. So for this full year, should we consider that we would be ending somewhere around mid-single digit growth and then follow on for FY27, we should start accelerating to double-digit growth?
Yeah, I don't know whether the growth will be single digit or whatever. It's hard for me to now say because we faced enormous headwind in Q4, as you know, Priyank, right? Our degrowth was in a much steeper than what we had anticipated. So I can't really comment for the year. Now my entire focus is a quarter on quarter. So what we can say is we are working at least for a sequential growth in Q2. That will be our focus. And apart from that, our only focus is to drive better order book. Now, mathematically, it will tell you that if we can deliver upwards of $850 million worth of order, then definitely next year we can show much more growth. Now, I don't know whether it will be double digit or whatever. That time will tell. But this is all keeping in mind, Priyank, that the uncertainties at some point in time settles down because we don't know what we don't know.
Very clear. And now this last question, and I'll come back in the queue. After the delivery of whatever the strategic actions that you have undertaken, you also mentioned in your opening commentary that we start this year with a very robust balance sheet. At the same time, when you are implementing internals, do we need to look into the externals to, acquire a better capabilities, diversify, and build a much more sustainable organization for the coming years? And
So Priyank, we have done a lot in building a solid organization per se. As you know, we have zero debt. We are generating positive cash flows. And from that perspective, I think we are world class. We need growth in the company, right? Now, an acquisition currently, at least to my mind, is going to be a distraction. We will not look at an acquisition today. We need at least 3 or 4 quarters of sustained quarterly growth performance and then look at something. But, we always are in the market looking at assets at any point in time, and if something really shows up which adds good value to us, then we are open to looking at it. But right now, the management the actions are very clear. We need to focus on building pipeline, delivering order book, and at least start delivering sequential revenue growth even before we think about an inorganic acquisition.
No problem. So just on that, it's a request from the minority shareholder to, focus better on the capital allocation for this year maybe. I'm not talking for a permanent change, but in this year we can think for a better dividend payout or a buyback, so that our return on equity and the return ratios become much more attractive. And as we start FY27, again the capital allocations as per whatever the decided policy can go on. Thank you.
Thank you, Priyank.
Thank you. We have our next question from the line of Dipesh Mehta from Emkay Global. Please go ahead.
Yeah, thanks for the opportunity. Couple of questions. First about the outlook. I think last time you indicated about quarter two to be growth quarter, and then I think for the full year also you made two observations. First about our aspiration to deliver at least positive growth in FY26, and second is EBITDA margin roughly around 13% for the year. So if you can provide your broad observation on some of these two things, whether we continue to aspire to reach positive growth and 13% EBITDA for the year. Second question is about, you indicated about right shifting of some deal. Can you help us understand whether those deals have are already closed or we are yet to see that closure happening? And whether it would be large size in terms of the relatively chunky deal compared to our usual size of the deal. If you can answer this question, then I have a couple of follow-up. Thanks.
Yeah, thank you, Dipesh. So Dipesh, first of all, on the Q2, I'll concentrate on Q2 first. Q2, our endeavor will be to deliver some positive growth. I can't commit on the quantum because the situation is very fluid, but all I can tell you, the management team is working on delivering some amount of sequential revenue growth in Q2. Now Q3, we will, like I said earlier to Girish also, that if I deliver a strong order book in Q2, then maybe Q3 we can continue our growth momentum. For the year, it is hard for me to say whether we will be positive, quite frankly, Dipesh, because we are starting from a much lower base. If you remember last year, our base was at about 160 odd million. Now you know where our base is. So mathematically, it will tell you that delivering positive growth may or may not be possible. It is quite difficult at this stage. But I will not comment for the year, and we don't give a guidance. We would like to take one quarter at a time. That's point number one. Point number two, on your deals construct. Look, we have won two reasonably large deals. One deal is getting signed in the month of August. So we have reasonable momentum on the deal flow. The two big deals that you're referring to, like I had said even in the last call, those are Q3, Q4 decisions. We are working on it. Hopefully we will be able to close one out of the two. And if that happens, then at least we will be able to deliver robust order book for the year, if not revenue. Dipesh, our entire focus this year, because of the fact that we are starting from a huge headwind position, is to really focus on quarter-on-quarter growth and delivering the order book, rather than looking at year-on-year, because year-on-year obviously will look very, very muted.
No, fair point. And on the margin side, if also you can comment.
Yes. So Dipesh, look, I mean, our first quarter, as you have seen, that our margins were at 12.4%, right? Last year, for the entire year, we delivered a 13% margin. Our endeavor is at least to keep the margins at that level. Now, I don't know whether we'll be exactly 13 or 12.8 or 12.6 or 13.1, I don't know. But it will be in that range. Our endeavor will be to keep the margins in that range.
Understand. Now I have a couple of follow-up. First about the manufacturing. If you can provide some sense how one should understand manufacturing growth playing out. There are some headwinds. So if you can give broad sense, if you can slice and dice into some sub-segment, how you are seeing demand trend there, and whether this pain is likely to be prolonged or you expect it to see rebound entering into second half. And second, similar question for ERP segment. So ERP, if you can give some sense. A couple of quarters back, I think you were hopeful about recovery in ERP. Now again, ERP is seeing challenges for last 3 quarters. So if you can give some sense there. And one question for Kamini. ETR increase, I think you provided some statement, but I missed it. If you can help us understand what led to this increase in effective tax rate. Thank you.
Yeah. So Dipesh, I will talk about the manufacturing and the ERP situation, and then I will hand it over to Kamini for her comments on the ETR. So look, manufacturing is a manifestation of what we are seeing in the market. Now, while we work with some really marquee names in manufacturing, the reality is we also work with a lot of mid-sized manufacturing companies in the US as well as in Europe. Now, with everything that is happening on the tariff side, there is also a little bit of uncertainty in terms of decision making and prolonged decision making. And as you also know, our manufacturing business actually sits in two areas. One is the pure manufacturing, and second is in the healthcare space also. We work a lot with med devices customers, which is also manufacturing. Now, if you look at it, I'm of the opinion that our med devices business is now turning around. That will continue to show positive momentum. Our discrete manufacturing is going to continue to be under pressure, which is why that has an effect on our ERP business, because the ERP and manufacturing business go hand in hand. It is hard for me to comment with the way the world is moving and way the tariff situation is playing out in terms of when this business will move around, only because it is a wait and watch policy in terms of our customers' decision-making process. So we will watch the space, and as the quarters go by, I will give you an update when the clarity comes in. But our endeavor on the ground is also to kind of turn the manufacturing business around and see if we can deliver growth in the coming quarters. On the ETR, I'll hand it over to Kamini.
Yeah. So Dipesh, like I had mentioned, if you look at our typical effective ETR, we've always been in the range of 25 to 26%. But this quarter we've had to take it to about 36% because of the provision that we have made. What I had called out was that we are engaging today with our tax experts, and we have started transitioning our terms of engagement with key customers. So our current assessment is that this impact is going to be for this financial year, and then going forward we expect the ETR to come back to our historical levels. So that's really our current outlook at this point of time, and we are working through this, engaging with the experts.
Understand. So broadly, I'm not very clear, let's say, what led to this increase? Because you said certain client you are in conversation and all those things. And this 35% plus kind of number is likely to be there for next 3 quarters at least. So if you can provide some sense, what led to increase?
So I think it's also a factor of, some of our engagements, Dipesh, that we are looking at, which is why I said we are engaging with our tax experts at this point of time. And, what we really need is to just work with our customers to realign the contract terms. So which is the reason why I'm saying that, I know this is much higher than what we've had historically, but we do expect to get this back. And I think our focus right now is to make sure that we take all the necessary steps to get back to this levels.
Okay, thanks.
Thank you. We have our next question from the line of Sandeep Shah from EQS Securities. Please go ahead.
Yeah, thanks. Thanks for the opportunity. Angan, in terms of whatever you explained till now, it looks like even after 2.5 years of effort in terms of turning around the ship and the Birla Soft growth profile, it still looks like our restructuring and turnaround efforts are undergoing. So what is not executing as per your plan? Is it more to do with the capability gap? Is it more to do with the execution aggression? Or you believe it's more to do with the macro headwinds which is impacting us?
Yeah. So Sandeep, look, if I were to make an honest assessment in terms of what is going wrong with us, there are 2 big things that is going wrong with us. And look, macro is where it is. That is not in our control, so I will not talk about it. It is our top 24 customers or top 40 customers, which essentially gives us 93% of our business. If you look at their performance over the last 4 quarters, they have not matched up to the kind of growth that we had seen probably 6 quarters back. Right? So they have slowed down. Now one can argue whether this is because their spending has been going down, which clearly it is. It is also because some of these work is becoming insourced as far as they are concerned. Some projects have got over, and which has impacted us in the last 6 quarters tremendously. So clearly our focus needs to go back into mining these accounts, winning more in these accounts to get back the business on track. That's number one. Number two, from a capability perspective, again, if you look at our digital and data business, they have done reasonably well. Our infrastructure business has grown significantly if you were to compare it over 3-4 quarters. Our one big issue that we are facing is ERP, and ERP is very coupled with our manufacturing business. So if I were to now look forward 4 quarters, what will be our plan? Like I was telling Dipesh earlier, Sandeep, my plan will be very simple. Go back to the basics on mining the 24 and 16 accounts. That's important. So the 40 accounts we have to mine. We have to start adding more and more newer logos in that, in the bucket of 40. That is number second. And number 3, how can we work with our partners like SAP, Oracle, etc., and invest in more leadership to turn around our ERP business. If we can do these 3 things, at least in the medium term, we can get back the company into a growth mode. Now, external economic factors, like I said, is not in our control, so hard for me to comment how that will move. But at least internally, these are the 3 things that we have thought of in terms of investments, in terms of push focus to get the overall company back on growth. Because remember, ERP still contributes with all the headwind that we have faced over the last 3-4 years. It still contributes to 200 million out of the 630 million that we have. So that's a big business.
Okay. But Angan, sorry to stress on this. In the review process, we should be having some amount of lead indicators about these things happening in the next 1 quarter, 2 quarter, or 3 quarters. So why the execution is more on the reactive approach rather than a proactive approach? Because the way you are explaining it looks like second half could also be a difficult period for us in terms of a growth.
Yeah. So Sandeep, look, it's not reactive. We know exactly what is happening, right? And again, there are a lot of specific areas. I can't discuss specific customer issues, but we know exactly which vertical, which account, which markets are really not doing well, and we have a plan to fix them, right? The only reason I'm not giving a forward-looking guidance, one is because we don't give a guidance, and second is because the uncertainty is so much, I am not being able to pinpoint something. But what I can tell you, Sandeep, is this. The entire management team is focused on those 2 things that I spoke about. One is creating pipeline, delivering the order book, and I will tell you, if we deliver the order book, the revenue will follow. And we have a plan in multiple levels. We have a plan for our top 24 clients, the next 16 clients, what we call as the attack accounts, which are 16 clients that we want to have in our portfolio. And there is a proper plan, account by account, people by people, service line by service line, which aligns to our long-term growth strategy. Now it will be all about execution, and execution from your perspective will be higher order book, and if we can deliver higher order book, then the revenue will follow.
Okay, fair enough. Thanks for the detailed answer. And sir, I think in the last earnings call we called out we had 2 large deals and each about $25-40 million in Q3, Q4. Plus, we are expecting another 2 close, which got delayed from 1Q to 2Q. And besides that, you also spoke about a couple of other large deals which are in the pipeline, which is needed to be closed in the second half. So, am I understanding this correctly?
Yes, absolutely correct, Sandeep. One deal, as you know, we closed in Q4 already. Another deal, we closed in Q1. The deal that got shifted into Q2 will also close. Had it not closed, then our order book would have come in at about 160-165 million, but that will close in Q2. And the 2 large deals that you're talking about are in the offering, but those, like I had said in the earlier earnings call, are a little bit of a long shot, and the closure date is also more like Q3, Q4. We will absolutely work on them, and we will see how we can convert. But more importantly, we also have to build our pipeline. We have to get more deals on the table, which the team is also working on.
Okay. And just last few things, in terms of EBIT margin target, which we have said last time, we are not changing that. This year we could be flattish plus or minus in a small range, and then from FY27 there could be an uptick in the margin. Is it the right way of understanding?
Yes, Sandeep, because look, at the end of the day, if the revenue is so muted, see from the cost side, of course, we have done a lot on the cost side, and we will continue to do a lot, right, on our overhead side and the cost side. But at the same time, we will invest in the right areas. So our going in position right now is that the EBITDA margins will be in the current range, give or take a few, which we spoke about. But as the revenue growth comes back, the margins will automatically improve because, the operating leverage will come into play.
Yeah, and last thing, Madam, just wanted to understand this higher tax rate which we expect in FY27 will have a cash flow impact, or we are doing just prudent provisioning of the same in anticipation of a higher tax outflow in the later years?
So Sandeep, it's a combination of both at this point of time, which is why I said that there would be some cash outflow that would happen on account of it. But, like we are engaging with our tax experts to see as to how we can work around it, right? So it could be a combination of both.
Okay. All the best, Kamini ma'am, and welcome, Chandru sir. Thank you.
Thank you. We have our next question from the line of Ravi Menon from Macquarie. Please go ahead.
Hi, thank you for the opportunity. I just wanted to ask about which side is the tech, high-tech customers, which vertical is that classified in? Saw that these three of your key deal wins are from that segment. Is that in manufacturing or is that in the services side?
It is on the services side, Ravi.
Okay. And life sciences, I noticed that we haven't really seen any wins. Could you talk a bit about that? What's the outlook there? Is that even apart from medical devices, is that still soft?
Yes. So Ravi, look, predominantly almost 80% of our business is medical devices. While we have not seen any win in Q2, there are a couple of deals that we are working on, even on the life sciences space that we hope to close between Q2 and Q3. We are working on them. I personally feel that the med devices industry per se, though it went through a little bit of challenge, it will turn around. But again, we don't know how the tariff situation will play out for them. We'll have to wait and watch. But at least the momentum is picking up in that area. While we did not win a deal, we have been selected by a very large med devices conglomerate as one of their preferred vendors, and we hope that some of the deals should be coming out of that over the next 2 to 3 to 4 quarters. So if you ask me, Ravi, I'm feeling a little bit more positive on the med devices space. On the larger life sciences area, we obviously don't work with any providers, and we don't have the capability to work with any providers, but we have started working with some of the payers, and as we sign up some new clients on that area, I will come back to you with an update, Ravi.
Thanks. And saw a couple of wins in insurance, so look like that's also picking up. How about the banking segment?
So, Ravi, again, as you know, while we call our business BFSI, but we don't really work with any banks, right? We work with asset managers, we work with payment providers, and we work with a little bit of insurance. Insurance is a very, very small business for us. We are winning some small little deals there, and we feel that will continue to show growth. On the payment side, we will see some softness going forward. But it will be seasonal. I feel Q2 will be a little bit of growth again in payments. Q3, because of furloughs, could be flattish. But in the long term, I think the payments as well as the asset manager space will grow for us, Ravi.
Thank you. And I noticed that this quarter, we've seen a bit of shift offshore. So should we expect that to continue, and will that help margins or you think that new deals when they're coming through, we will have to keep the on-site offshore mix more or less at the current levels?
Ravi, our expectation it will be more around the current levels. I think the shift that you saw was largely because some of the degrowth has happened more on-site at this point of time, and that's the reason that we expect it to remain at the same levels.
All right. Thank you, Ravi. Best of luck.
Thank you. We have our next question from the line of Shraddha Agarwal from Asian Market Securities. Please go ahead.
Yeah, hi, sir. We've seen our sales and support headcount coming off for the last many quarters. And if you look at on a YOY basis, it's down almost 17-18%. So what is happening there? Is it more of overhead staff that is going out, or are we also looking at rationalization of our sales team?
Yeah. So Shraddha, our going in position is to invest in sales. So you should not take this as a cutting of sales force to enhance margins. That's not the idea. We will continue to invest in sales heavily going forward as well, and you will see an uptick. But we will invest in specialized sales instead of generalistic salespeople. Also, Shraddha, we will measure sales productivity very, very strongly. I can't comment today whether we are right-sized in terms of sales or not. That will be driven by productivity, and there is a big exercise that is going on. But the larger point that I made earlier, I think to Priyank or Dipesh, is we will have the right roles in the right geographies, right? So from that perspective, we are rejigging our workforce a little bit. But investments in sales in the right kind of accounts that give us growth will continue.
Yeah. And Shraddha, just to add to what Angan said, right, while we continue investments in the sales area, the reason why you see a reduction is we are also looking at a lot more internal optimization and automation in our internal processes, which is why our support headcount has also been showing a declining trend. So while it's clubbed together for you from your standpoint, sales and support, the reduction is not in the sales area. It's largely in the support area that we are.
Sure. So my related question is, any progress on hiring of CEO Americas after the exit of Mr. Root? It's been, I think, more than 2 quarters that we've been looking for his replacement. So any update on that?
So Shraddha, we will come back to you on that. I mean, there is some thought process that we are going through at this stage, and at an appropriate time, Shraddha, we will come back and update you on this.
Right. And so just last one question from my end. Many companies have been talking of gaining incremental market share in vendor consolidation deals. So what is our status on such consolidation deals that come up in the pipeline?
Yeah. So some of the deals that I talked about that we have won, part of it, of course, is vendor consolidation, and some of the other deals are also new deals, which is more agentic AI. I mean, one of the deals where we are delivering to our clients with agentic AI solution is a part of the consolidation deal. So we're winning our fair share of consolidation deals as well, Shraddha. But like I said, our focus, rather than just driving vendor consolidation, is to kind of win new transformation deals for our clients, which is more AI-centric, and where I will be able to use my AI platforms to deliver.
Right. And so just one last question. ROW saw a steep decline. So the manufacturing decline and ROW decline are related?
Yeah, it is related because there are some manufacturing clients spend. And these clients are really global clients, so we cannot classify whether ROW or in the US. But you're absolutely correct, Shraddha, that aligns with the manufacturing decline. But overall, ROW outside of manufacturing has done reasonably well. In fact, the 2 or 3 deals that we are signing or about to sign are actually in the ROW area.
Great. Thank you. Thank you, Honorable Sir.
Thank you. We have our next question from the line of Sudhir Guntupalli from Kotak Mahindra AMC. Please go ahead.
Hi, and thanks for the opportunity. So my question is, I think a follow-up on what one of the earlier participants asked on Q3 growth. So you're saying the deal that got right-shifted is almost signed in the month of August. And if things, especially on the macro side, I understand that there is a situation is very fluid. But if things, let's assume things stand status quo, and given that we have the comfort of that deal signing, and the deal signings happen to be higher than what they were in this quarter, then is it fair to assume that December quarter will also be a growth quarter, despite, let's say, 150 basis points of headwind due to furloughs, which is seasonal? Is that the right math to assume?
Yeah. So Sudeep, I will break this up for you, right? So that, I communicate it clearly, and I'll also ask Kamini to step in on this one. So look, if I can sign more deals in Q2 than Q1, roughly about anywhere in the range of 160 to 165 million, in that range, if I sign, then clearly Q3 will also be a growth quarter. The only reason I am not being able to say that with thumping on the table is because I don't know how much furloughs will my customers come back with. See, the growth, operationally, I can tell you I will grow in Q3. But the problem is, how much hit will I take because of furloughs is too early to comment, because as you know, 50% of my business is manufacturing, and depending upon how the tariff situation goes for them, we don't know how much amount of discretionary cut they will have. As a result, how much furloughs they will ask us to take, which is the only reason I'm saying this. But operationally, if you ask me, we'll absolutely grow in Q3 as well. Barring, the only caveat here is, if the furloughs are more than anticipated historically, then obviously we'll have an impact. Otherwise, we will grow.
Fair enough, sir. That's why my question had a predication that broadly in the historical range, given that it is too early to predict furloughs. But otherwise, you don't see, I think this is regarding asking for some more clarity on one of Sandeep's earlier comments that says that H2 is sounding, we are sounding a bit weak. I'm just trying to get some clarity on his comment because I was not there for the full extent of the call. Just that part.
Okay. Yeah. So Sudeep, let me clarify, and I think Kamini clarified this to Sandeep as well. To Sandeep as well. So look, we are entering Q1, as you know, we entered Q1 with a lot of headwind, right? Earlier, our revenue base was roughly about $160 million. We entered, or rather we ended Q4 at about $152 million base. So we had a huge headwind because of closure of projects, ramp downs, and a lot of the work going to the captives. Now, if I were to take that base, right, and growing from here, and you will be able to do the math, we'll need substantial amount of sequential growth to show growth from there on, right? So which is why my request is, and I know this may be not the right way to say it, but let me focus on quarter-on-quarter performance rather than year-on-year performance, because with that kind of headwind, year-on-year performance may not make too much sense. So my entire focus and my management team's focus is first deliver growth in Q2, and then, like we discussed, if there are not too much furloughs, deliver growth in Q3 and then Q4. But at a larger scope, if I can deliver this, what I just said, focus on quarter-on-quarter, and deliver about 850 million of order book, then at least next year I can commit to a solid growth here.
Fair enough, sir. I was just trying to get that confidence on sequential basis only, quarter-on-quarter growth trajectory for the second half, not on a year-on-year basis. Since one of the earlier comments by one of the participants seemed to imply otherwise, that's the only clarity I was saying. Thanks for the clarification.
Thank you, sir.
Thank you. We have our next question from the line of Abhishek Shindkar from InCred Capital. Please go ahead.
Yeah, hi. Thanks for the opportunity. Just one question. Sir, historically, when we have had a hunting and a mining team restructuring, typically, what is the time frame within which they actively start contributing to the new pipeline, especially the hunting team? Any colors in terms of that timeline could be useful. Thank you for taking my question.
Yeah. So Abhishek, the hunting team actually does two things, right? One is Either they work on a deal in a new account or they open a new account, right? So let me take both the questions separately. When you're working on a new deal in a new account, that depends upon the deal closure. If the deal closes quickly, we can start getting revenues quickly. But the other, rhythm or a cycle in the hunting motion is to open an account, sign an MSA, get the account in our fold, and then you start walking the floors. My personal take is when you open a new account, sign an MSA, and start walking the floors, by the time you close the first deal and see the first dollar of revenue, it could take anywhere between 6 to 12 months. That is the motion of a new account opening MSA, which is why we put an account manager who starts walking the floors, and over a 2-3 period, the account can become 5 million, 10 million, 20 million, which is the account mining exercise. But the other rhythm where you are working on a deal in a new account, that could close whenever it closes. Could be 3 months, could be 6 months.
Understood. So my question was more about the business in existing accounts versus the NN business. So generally, 3 to 6 months is the time frame when the new team, would take to get, the EN business. Is that the right way?
Absolutely, yes. Yes, Abhishek.
Perfect. Very helpful, and thank you for taking my question.
Thank you. We have our next question from the line, a follow-up from Girish Pai from BOB Capital Markets. Please go ahead.
Yeah, thanks for the follow-up opportunity. I just had one question. You mentioned insourcing and captive a couple of times, or maybe more than twice during this call. Are these multiple clients, and why is the insourcing happening? Is it that the clients can do the same work at cheaper rates within the captives, or any specific reason why the insourcing is happening?
So no. So Girish, you must not look at insourcing from a rate perspective. It's not about rate. It is more about standing up their GCCs and getting that off the guard. It could also be some amount of work which are more regulatory in nature, which needs to be within their four walls. So I would not read too much into that. It was more to explain in terms of the fact that we have not lost those deals to competition. We've lost those, actually lost is the wrong word. We've given up those people or that piece of work to an insourcing rhythm is what I was referring to. It's nothing got to do with price, Girish.
And are these more than 2-3 clients?
So again, we will not talk client specific, but yeah, it is more. It will be a couple of clients. It's not more than 2 or 3 clients, but it is in that range.
Okay, one last question on pricing. How is the pricing in the market today compared to, say, 3 months back or 6 months back on discretionary work, the so-called discretionary work?
Yeah. So look, the pricing is going to come under a lot of pressure, right? Which is why, Girish, if you remember, my first comment was at least to get my renewals done at the current price levels and not give discounts on the renewals. And that itself is a lot of effort considering the macroeconomic situation. Now, as far as new deals are concerned, on discretionary or even non-discretionary, there is enormous amount of pricing pressure at this stage, which is why we are taking 2 strategies, actually 3. One is trying to get the renewals done at the current pricing, number 1. Number 2, getting our organization cost structure corrected to reflect the new reality of the pricing pressure that we will go through. And third, of course, we will also be aggressive in the market to gain some market share, but strategically win some deals at a little bit more competitive pricing.
Thank you.
Thank you. We have another follow-up question from the line of Sandeep Shah from Equirus Securities. Please go ahead.
Yeah, thanks for the follow-up. Just a bookkeeping question. If I just look at the intangible asset, both which is mentioned as other intangible and intangible asset under development, it has gone up on a YOY from $1.4 million to $3.1 million, and largely because of the intangible assets under development. So I agree, as a percentage to revenue, it's not very big, but what is leading to this increase?
So Sandeep, it's actually, if you could recollect, we had mentioned, about our own in-house transformation program that we had been doing a couple of quarters back, Optimus. As we are building it up, it's really the cost associated to it.
So Optimus is one of the solution or a tool which we are developing.
Yes, absolutely.
Around automation or?
It is actually, an entire platform that we are creating in-house for our own internal purposes in terms of transforming our organization.
Okay. Thank you. All the best.
Thank you.
Thank you. We have our next question from the line of Devashish Mazumdar from Swan Investments. Please go ahead.
Good evening. Hi, Angan. Thank you so much for taking my question, and Kamini, all the best for your future endeavor. So, Angan, I have a little bit of strategic question in my mind. If I see your journey in Birlasoft, once you joined after we faced a huge headwind from Invacare, which was kind of managed well, then we came back into the growth mode for 2 to 3 quarters. Because some of the changes has been done, some strategic changes has been made, client consolidation has happened, hired new people. Then if I see over the last 2 to 3 quarters, we suddenly kind of collapsed from that growth journey. So, and obviously because of that, our margin also got impacted. So according to your analysis, what was the reason of this impact? It was like job half done when we were kind of changing strategically 3-4 quarters back. It was more of a macro impact that we have faced, or it was more of a client specific or vertical specific issues that we have faced. So according to your analysis, what are among all these three, what is the main reason according to you in your mind that has impacted us the most? And the second is, at what level of transition that we are in, and according to you, how much time it will take approximately to get back into the growth phase?
Yeah. So, Devashish, first of all, thank you for this question. So there are a lot of questions in one question, but I'll try and summarize and answer them, right? So look, fundamentally, there is nothing wrong with the company, right? The company is strong, and that shows up in our balance sheet, that shows up in our cash flow generation. The very fact that we have no debt, we've been able to generate positive cash flows every year shows that we are a fundamentally strong company. What we need is growth. Now, where did growth go wrong? It went wrong in two or three areas. One is, like I was mentioning in earlier things, some of our customers have insourced a lot of work. Some of the projects have finished and they have not got renewed. And this has happened in about 2 or 3 clients, not too many, maybe at best 4 clients out of the 250 clients that we have served. But over the last 4 quarters, we've lost a lot of revenue because of that, correct? But equally, we won a lot of business, which is why, though we've lost a lot of business, we have still been able to stay at the current levels, which is the commentary that you made, that in the last 4 quarters, we've worked to only be in the same place. I feel personally that, this is an ongoing journey. We have made lot of changes in the organization. And when I mean changes, I don't mean people changes alone. In the way we work, the way we serve our customers, the kind of capabilities that we build, the kind of capabilities we want to build for the future. Even in the year that we did not do well, we've given our people salary hikes, promotions, and everything. Right? So we are investing in our people, we're investing in our capabilities, and we have a long-term view about all this. It's hard for me to say that how many more quarters will it take for consistent growth to come back. See, look, we are attempting to deliver growth even in Q2. So technically in Q2 we will deliver growth. Hopefully if the furloughs are not too much, we should deliver growth in Q3 as well. But if the furloughs are way too much, then I can't obviously comment. Now, it's an uncertain world. I will have to focus quarter on quarter, take 1 quarter at a time, and then build on it. But of course, our endeavor is to get to consistent quarter on quarter growth for 4, 5, 6, 7, 8 quarters sooner rather than later. So it is not a job half done. We continue to do the job, and we are fiercely committed to our customers, to our people, and we will build a strong, robust company in the long term.
Sure. And when you said that building a robust company in the long term, from your recent experience at least, where do you think that the maximum gap is? It is like depending on a one single vertical, which is very volatile in nature, or kind of depending on few single customers, where again you can have higher pressure going forward. So according to you, what are the areas which need to be addressed very, very urgently?
Both. What you said, both. Traditionally, we have been an ERP company which has not shown growth. We are big in manufacturing, which has not shown growth, right? So we have to do both. We have to acquire new customers. We have to also mine our existing customers, and over time we have to build up manufacturing back to growth path, while life sciences and energy utilities and all of the other businesses continue to grow.
Sure. Understood. Thanks, and thank you so much for answering my questions.
Thank you, Devashish.
Thank you. We have our next question from the line of Vibhor Singhal from Nuvama Institutional Equities. Please go ahead.
Yeah, hi. Thanks for taking my question. I'm sorry, I know we have passed the review time. I'm sorry to harp on this question again. I'm just trying to wrap my head around the tax thing that Kamini you mentioned. So first of all, just want to clarify, you are saying that for the next 3 quarters in this year also, we will have 35% tax rate. Did I get that correct?
Yes, that's absolutely right. For this year, we're looking at a tax range in this range, yes, an ETR in
Right.
this range.
Got it. So now just want to understand the nature of this thing. So is this some sort of a tax demand that has been raised by the department that we are trying to fulfill? Is this some kind of re-evaluation that we are doing? You mentioned that some of the projects and you're trying to work on what has a project got to do with the tax? Because I think that is a different kind of a thing. So just trying to understand the nature of this expense that we are looking at for the full year.
So at this point of time, like I said, since we're engaging with our tax experts, we're actually re-looking at our models that we work with our customers to be able to align to our operating models, which is the reason why I think we are kind of giving you a very limited information at this point of time. We're working through this. But I think what we can say with a lot of certainty is that given the work that we've done so far, we see this as an impact for the current year and not beyond that. So allow us some time to work through this, and probably we would come back to you later on.
Got it. Sure. Thank you so much for taking my question, and wish you all the best.
Thank you.
Thank you. Ladies and gentlemen, that would be the last question for today, and I now hand the conference over to Mr. Angan Guha, CEO and MD, Birla Soft Limited, for closing comments. Over to you, sir.
Yeah, thank you. Thank you so much. So to begin with, I would like to thank each one of you for your interest in Birlasoft and for your insightful questions. At Birlasoft, we have undertaken and initiated several actions over the past couple of quarters to secure our long-term profitable growth objectives. And we've discussed this in the last 1 hour, that while the macros are unfavorable for a few quarters, we believe that we are well positioned to benefit from the emerging market conditions. I feel our first goal will be to deliver for Q2, and we are working on delivering some growth in Q2, and then take it forward from there on. Like I've mentioned multiple times, we will take 1 quarter at a time, and our focus clearly this year is going to be to deliver more and more funnel and more order book. So thank you once again. I look forward to speaking to all of you again next quarter. In the meanwhile, please feel free to reach out to Abhinandan for any clarifications or feedback. Thank you, and thank you, and have a great evening.
Thank you. On behalf of Birla Soft Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.